Right now, the area getting the most attention in the economy is probably the exchange rate. As it stands, the value of the Korean won is practically becoming worthless. According to today's news, it even reached 1,475 won during the day. Foreign investors keep selling in the domestic stock market. On the 12th, they sold a net 428 billion won, and by 10:45 today, another 94.6 billion won had been sold. The exchange rate is increasing rapidly. Today, let's examine this, as it has reached 1,475 won. Some predict the exchange rate may exceed 1,500 won due to its rapid rise. Lee Chang-yong, the governor of the Bank of Korea, made a public verbal intervention. Nevertheless, the exchange rate continues to rise. There are many reasons why the exchange rate is going up. The main reason appears to be the interest rate reversal between Korea and the United States, as rates are not currently increasing. Currently, Korea's base interest rate is 2.5%, while the United States' base interest rate is 4%. The interest rate difference between Korea and the United States is about 1.5%. Since the United States' base interest rate is higher, the exchange rate is rising. Holding dollars is more beneficial than holding won. However, the fact that this interest rate inversion has continued for the longest period in Korean history is also a big problem. Up until now, there have only been 4 instances of interest rate inversion in 1999, 2005, 2018, and now. There have only been these 4 times. Previous interest rate inversions typically lasted 21 to 25 months, but this one has continued for 41 months since 2022. The period is too long. Additionally, the inversion gap was 1.5 percentage points in 1999 and has now reached the same level. This is because the United States lowered its base interest rate, reducing the gap. Since the gap has been large and persistent, the exchange rate keeps rising. You might be thinking this. You might ask why the Bank of Korea isn't raising interest rates right now. The biggest reason is the housing price issue. The reason why the interest rate was kept unchanged at the Bank of Korea's Monetary Policy Board meeting was also because of housing prices. If interest rates are raised in the current situation, the debt problem could become even bigger. Of course, some property owners may have to sell their real estate to pay off their debts. As a result, there's a high possibility that housing prices will fall and the real estate market could be greatly shaken. Above all, this risk increases if interest rates go up. Currently, due to debt problems, there is a high possibility that both individuals and companies could go bankrupt one after another. That's why people are approaching the situation very cautiously right now. Korea's debt problem is also the next reason. Currently, the government debt ratio has reached an all-time high compared to gross domestic product. The country's total debt, including government, household, and corporate, hit a record 6,373 trillion won at the end of Q1. The government debt to gross domestic product ratio is rising over time. In early 2020, it exceeded 40% for the first time at 40.5% and has steadily increased since. It rose from 44.1% in Q1 2023 to 45.2% in Q1 2024 and reached 47.2% in Q1 2025. It is the first time in 35 years since 1990 when related statistics began to be compiled that the ratio of government debt to gross domestic product has reached 47%. The government debt ratio remains low compared to major countries worldwide. Our country is at 47.2%, while Japan is 200.4%. Greece, 150.9%. Italy, 136.8%, and the United States, 107.7%. However, the issue is Korea's high household debt ratio, currently at 89.5%. Although it's decreased slightly, this household debt ratio is still 6th highest among Organization for Economic Cooperation and Development countries. Switzerland is at 125.3%, Australia at 112.7%, Canada at 99.1%, the Netherlands at 94%, and New Zealand at 97.1%. With high household debt, rising interest rates could seriously hurt borrowers. The impact is hard to predict. Another major reason is the significant increase in money supply. Since January 2022, Korea's money supply has grown by 20.4%, a significant increase. Meanwhile, the United States rose by 3%. This shows the Korean won is quickly losing value. Until recently, Korea had policies similar to the United States Federal Reserve. If the United States raised interest rates, Korea would also raise them. And if the United States increased the money supply, Korea would do the same. They continued their policies in a similar way. As shown earlier, when Korea quickly increased the money supply, the exchange rate inevitably surged. On top of that, as I mentioned earlier, the United States has a higher base interest rate. Above all, the biggest problem in the market right now is this. The problem is that there are hardly any people who want to sell dollars and hold won. Investors, companies, and even ordinary individuals are all moving toward holding dollars. The won's appeal has fallen sharply, while the United States keeps high interest rates and attracts global capital. The United States Federal Reserve is maintaining high interest rates to stabilize prices, causing global capital to flow into the United States. Because Korea's benchmark interest rate is lower than that of the United States, a structure has been created where holding the won results in a relative loss. For investors, holding dollars earns more interest and could gain value, so there's little reason to trade for one. Recently, the United States government has strongly pushed major allies companies, including Korea, to make large investments in the United States, citing domestic production expansion, as building United States factories for key sectors like semiconductors, batteries, and electric vehicles is now almost required. Major Korean firms are quickly securing and moving funds to the United States. As this trend continues, demand for dollars in the foreign exchange market is surging, putting downward pressure on the Korean won. Companies need dollars for United States investments, while individual investors find United States assets more stable and profitable. In other words, the possibility of funds in Korea being converted back into Korean won and returning is gradually disappearing. As the global economy gets more uncertain, people prefer safe assets even more, increasing the demand for dollars. In a situation like this, holding Korean won means not only taking losses due to interest rate differences, but also bearing the risk of exchange rate fluctuations. On the other hand, if you hold dollars, you can expect not only interest income, but also additional exchange gains whenever the value of the Korean won falls. With this structure, investors have little reason to invest in Korean won. Not selling dollars isn't just a technical issue in the foreign exchange market, it's also a sign of declining trust in the Korean economy. To reverse the trend, we need a clear policy to reduce the interest rate gap or make Korean won assets more appealing. However, the government and the Bank of Korea have yet to come up with a clear response. Meanwhile, the market is reorganizing around the dollar and the Korean won keeps weakening under pressure. The financial sector predicts that if the exchange rate hits 1,481, authorities may hedge or intervene, so a sharp further increase is unlikely. However, unless key issues like interest rate hikes or Korea's fiscal deficit are addressed, this problem will likely remain. The problem is, if they try to raise interest rates, it becomes difficult to handle the existing debt, so the economic authorities are in a dilemma. A rising exchange rate may initially appear beneficial for export companies. Receiving export payments in dollars makes it seem like sales are rising, but it's actually more complicated. The Korean economy relies more on imports than it earns from exports. Most raw materials, energy, and parts are imported, so a higher exchange rate raises all their costs. Even with dollar payments, rising raw material costs reduce actual profit. In Korea, where manufacturing is prominent, this directly reduces company profits. Industries like semiconductors, steel, shipbuilding, and automobile are heavily influenced by exchange rates. From the company's perspective, the burden of costs increases, and at the same time, their price competitiveness in overseas markets declines. This creates an export illusion. Exports rise, but gains are unreal. Worse, the shock ultimately impacts people's lives. When raw material prices increase, electricity, distribution, and food costs also rise. Energy and food are especially import dependent. Coffee, flour, cooking oil, and processed food prices keep rising, directly increasing grocery costs for consumers. Companies have no choice but to reflect the increased costs in their prices, and this ultimately leads to a decrease in people's real income. As prices rise, but salaries stay the same, people's economic power decreases. If the exchange rate stays around 1,500, one price stability will be impossible. Electricity, gas bills, and prices of construction materials and industrial parts using imported raw materials will all increase. This will eventually create a vicious cycle of rising production costs for companies, reduced consumption, and an economic slowdown. Even with higher exports, domestic demand stalls, and rising prices reduce purchasing power, greatly increasing the burden on ordinary people. Especially for households with loans, the simultaneous burden of rising interest payments and living expenses puts them in a situation where it's hard to withstand the economic pressure. Companies face rising currency risk management costs, exchange rate losses, and added hedging and liquidation expenses. In the case of small and medium-sized businesses, there is a rapid increase in cases where they can't handle these costs and their profitability worsens. Recently, import companies have felt the burden of dollar payments and are cutting back transactions or delaying contracts. In other words, the rise in exchange rates is not just a numbers issue in the financial market, but it's shaking the entire circulation structure of the real economy. Consumers are suffering from rising prices, companies are suffering from increased costs, and the government is being forced to make policy choices between reduced tax revenue and inflationary pressure. Rising exchange rates are more than market fluctuations. They impact every sector and strain the whole economy. Hope you choose a good unit. What are your thoughts on the current exchange rate? Share your comments below. That's all for this video. Thank you.